If you go through our website, blog articles or videos, you will observe that we have always projected equity as a wealth creator over the long term. Now there are two questions which arise with this assertion. Question 1, what about the risks involved? And question 2, what is long term and how certain is this wealth creation? So I have addressed question 1 in the previous video titled Identifying Real Risk. Do watch it. You will get some interesting insights from there. So let's tackle question 2 and see what we mean by long term and why we say that there is an element of certainty of returns in equity over the long term. So what do we understand by the word equity? It means ownership, partnership, or a share in business. It means if the business fails, you lose your money. On the other hand, if business succeeds and thrives, your returns are multifold. Buying shares on the stock market or through equity funds is buying equity. All businesses go through the cycle of recession, recovery, boom, and then downturn. This one cycle may happen over a number of years. Good businesses create multifold returns over time because they are able to survive the tough times and thrive in favorable conditions. So each boom catapults these companies to the next level, and as they grow, so do their valuations and hence the stock prices. But on a day-to-day basis, this is not visible. So people react to news, rumors, and the moment they see a dip in prices, they sell their investments in panic and then they say equity is not for me, it is too risky. There are umpteen examples of wealth creation by individual stocks over a long period of time. Companies like Hindustan Unilever, Infosys, Wipro, Hero Motors, HDFC Bank are a few examples of this. I will narrate two instances of people having created wealth out of investments in IPO over the long period of time. So let me quote an example of an IPO investment in HDFC Bank. This was an issue which came in 1995, and if an investor had invested 10,000 rupees, he would get 1,000 shares. Now, if he has not done anything with that after doing this investment, today the value of his investments would be 63.5 lakhs, a return of almost 36%. Another example, Infosys. The issue came in 1993. If you had invested 9,500 rupees, you'll get 100 shares. And these 100 shares, or this 9,500, would be worth 5.37 crores today. This is a return of 45% per annum. But again, provided you did nothing in the intervening period. So assume that this investor has been your neighbor. You would call him lucky and envy him. But luck has played a very small part here. You have to understand that there would have been a lot of times when he would have been tempted to sell either because it had gone up and there was an opportunity to book profits, or because it had come down drastically and he had panicked. It is his ability to remain patient and not take any hasty action has shown him these valuations today. Investing in stocks is not for everyone. The returns projected above are exceptional and not the norm. Thankfully, in our endeavor towards investing for a secure financial future, we do not need these kind of returns. A few percentage points over inflation for 3 decades works wonders on your portfolio valuation. The best method of investing in equity for a person who doesn't have the time or resources to research and select stocks to buy is to invest through mutual funds. Fund managers are expert professionals to do exactly this job. So I want to give you an example of a mutual fund return also. So there is this particular scheme, equity fund, which if you had invested rupees 10,000 in 1993, would be today worth 9.65 lakhs. This again would happen only if you have kept the investment throughout and not taken any hasty action in the intervening period. This is a return of 22%, by the way. To my mind, investing is not the problem. The main problem comes after investing. A lot of mutual fund investors exhibit the same impatient behavior as the stock investor. They start checking on the portfolio values on a regular basis. Then they start listening to the media channels, read newspapers, or exchange ignorance with friends. And this triggers precipitate action, most of the time with disastrous consequences. Your job as an investor is to invest and stay put. Do not get excited by short-term spurts, nor panic when the market suddenly dips. And stop looking at your portfolio on a daily basis. You will be happy that you stayed invested. Thank you for watching.